Welcome to this session. In the last session, we had discussed the money supply creation process, where we discussed the deposit creation and where deposit multiplier, and subsequently we had discussed money multiplier process as well. So, there we have seen that in addition to central banks, there are other participants, stakeholders who also influence the level of money supply in the country, in an economy. So, today our focus is on central banking's monetary policy. So, in the case of monetary policy, we are going to discuss what are the tools of monetary policy and then what are the approaches. So, this is the broad overview or broad aim of this session and subsequent sessions. And coming to this monetary policy, the each and every component tools of this monetary policy we will be discussing over time. Whenever we discuss in appropriate context, we will discuss. For example, the open market operation, we already had a discussion, and similarly discount loans and required cash reserve ratio. Required reserve ratio, this also we had introduced this concept in the discussion already. So, what we will do that we will present put these tools in appropriate context and then see how using each tool the central bank is able to determine the level of money supply in an economy. So, to begin with, we can see that there are three broad tools of that is quantitative tools of monetary policy. In addition to that, there are several other tools, most of them are qualitative and little bit advisory kind of things that also we will discuss in the later sessions. In this session, we focus on applying or that how monetary policy is conducted and what are the targets, etc. That will be the focus here. So, just to see that here there are three tools. One is open market operation, that is open market purchase or sale of government securities by central bank among the commercial banks. That means central bank and the commercial the banking system are involved in the open market operations. And then comes discount loans. Discount loans means giving loans to the commercial banks, to the banks by the central bank. And required reserve ratio is the percentage of the total percentage of a certain fraction of the total demand and time liabilities, demand and time deposits that the banking system has to keep with the central bank. And another there are two broad targets or approaches in the monetary policy regime. One is called interest rate targeting. Then the second one is called monetary targeting or money supply targeting. So, in the case of interest rate targeting, the central bank targets the interest rate as their main outcome target that they want to achieve. Suppose this is the interest rate in the country should be, for example, 2%. It may be short term. A short term interest rate is 2%. That is the target. That is one approach. Another approach is targeting the money supply itself. So, see that this should be the money supply in the country. For example, the M3 money, say for example $1 billion for example, this is one of the target. So, you know that between both this target and this target, both are actually ultimately aim of monetary policy is to influence the liquidity in the country. So, in this case, both are actually aimed for attaining the same goal. So, sometime we will make a detailed discussion of the pros and cons of both approaches. What are the pros and cons of if the central bank follows interest rate targeting, and what are the pros and cons of if the central bank follows monetary targeting. That we will discuss in the future sessions, because we will be discussing this one, and also we will be applying in different country settings how they use different types of targeting. And ultimately what we are going to see that this will be affecting the level of liquidity in the country, and then subsequently also affecting the level of economic activity. Coming to this overall, the outline of this module including this session and some of the forthcoming sessions, we will discuss the monetary policy tools and targets. In the US, recently they have been following interest rate targeting. So, there we will discuss how interest rate has been determined in the economy, and in order to discuss that, we will be making an overview of the structure and activities of the US central banking system, that is called Federal Reserve System in the US. And then subsequently we will discuss what are the mechanism of interest rate determination in the US, that is Fed fund rate determination in the US. And after completion of this discussion, in one of the following session, we will focus on India's monetary policy. In contrast to the interest rate targeting in the US, India follows the monetary targeting, that is the money supply targeting. So, here we will make do a overview of the structure and activities of the Reserve Bank of India, which is the central bank, and then we will discuss the mechanism of the conduct of monetary policy in India, how what are the tools used and how do these tools are used to attain the necessary target of monetary, that the money supply in India. Okay, so these are the overall module outline. Let me now start with this particular session. Here we will be making an overview. We will be discussing the structure and activities of the Federal Reserve System, and then subsequently we will moving to the mechanism of interest rate determination. So, since we are talking about the central bank, who is the monetary authority and the apex bank in the country, and who is also vested with the responsibility to ensure monetary stability, the financial stability as well as economic stability, it's better to know what are the structure, what is the how the US central banking system has been structured and what are their activities. Then you will be in a better position to relate their monetary policy activities, monetary policy interventions in the economy in a different context. So, coming to the Federal Reserve System, the origin of Federal Reserve System in the US. Initially there was resistance among different stakeholders in the economy, especially from bankers and different financial institutions. That means setting up of a central bank, the name itself saying a centralized power, right. So, a centralized power, so there was resistance to the establishment of a central bank in the US. So, there was mainly because a fear of a centralized power, and in addition there was distrust of such a moneyed interest. That means one monetary authority, one central bank controlling all the banking system and all the financial system, and there was overall little bit distress of moneyed interest. So, actually until 1990s, in the early 90s, there was no central bank in fact, but later on, the early beginning of 19s, then there was little bit the importance of setting up of a regularized central bank was considered as relevant. So, what we can see here is that there was no lender of last resort when there was nationwide bank panics on a regular basis. So, you can see that there was panic of 1907 so severe that public was convinced a central bank was needed. And also we have seen that in during great recession time, there was also actually the recession, Great Depression of 1930s, that was also characterized by bank failures. That means so many banks failed at that time. So, here that means the frequent bank panic, that is one of the reason the general public began to think that we need a central bank, because their money is with the banking system, their savings are with the banking system. So, they need someone who can control and ensure a sound banking system in the country. So, accordingly the Federal Reserve Act of 1913 was passed. So, it was mainly an elaborate system of checks and balances in the act, and how to control the banking system and the financial system, and how to ensure monetary and financial stability in the country. And the act proposed mainly a decentralized structure not like central bank, not like that. Unlike it was, they proposed a more decentralized central banking system. So, accordingly, the writers of the Federal Reserve Act wanted to diffuse power along regional lines between private sector and government, and among bankers, business people and the public. So, you can see that actually there are it's actually mostly this is decentralized, that means to diffuse power along regional lines. So, you can see here that private sector is involved, because private sector including firms, they are the dominant borrowers from the financial market, then the government, and then not only that, even the bankers, that banking system is another important pillar, then business people and the public all are involved there. So, the initial diffusion of power has resulted in the evolution of the Federal Reserve System to include the following three key system entities. One is the setup of the Board of Governors of the Federal Reserve System, and second one is Federal Reserve Banks, and the third one is the Federal Open Market Committee. So, here what we can see that unlike Indian central bank, India's central bank, where we have only one central bank called RBI, Reserve Bank of India, and that is mostly by a centralized power, not representation from bankers, business people, general public, etc. As compared to this, in the US, there is no central bank as such, one central bank as such. Instead, there are groups of central banks, that means regional central banks. So, that means there are Federal Reserve Banks. So, because of that, all the central banking we call with Federal Reserve System, we do not call a single central bank as such in the US. So, we call it as Federal Reserve System, and which has many regional central bank. And another pillar is that the Federal Open Market Committee was also set up with the central banking system, Federal Reserve System, who is entrusted to conduct the open market operation to attain the monetary policy targets. So, I would suggest you visit the website of Federal Reserve System, where you will get detailed information about the Federal Reserve System, how it evolved, and what are the functions, what is the structure, and with the intervention that all the Federal Reserve System has been doing. So, where is Fed located? So, you can see here that there are 12 Federal Reserve Banks. So, that is called Federal Reserve District. So, you can see that there are 12 banks starting from here like that. So, that means is located across the country. So, is actually we can call it also as regional banks. For example, this area is coming in the bank, that 12th regional Federal Reserve Bank, like that. So, here is the area of Federal Reserve Bank 1. So, this map is to show that actually there are 12 Reserve Bank, 12 Federal Reserve Bank that are located across the country. This is the structure and the responsibility for policy tools in the Federal Reserve System. So, the Federal Reserve System, you can see that the Federal Reserve System, the Board of Governors. So, you can see the Board of Governors, 7 members including the chairman appointed by the President of the United States and confirmed by the Senate, and appoints 3 directors to each FRB, and there are 12 Federal Reserve Banks, each with 9 directors, 6 of whom appoint president and other officers of the FRB, and they elect 6 directors to each Federal Reserve Bank. So, there are member banks, there is more than 2000 member commercial banks. So, this is the structure. Then there is the Board of Governors, and these 12 Federal Reserve Banks, they form a Federal Open Market Committee. So here there are 7 members of Board of Governors plus presidents of Federal Reserve Bank of New York and 4 other Federal Reserve banks. So that means the Open Market Committee, the Federal Open Market Committee was set up by through Board of Governors and 12 Federal Reserve Banks representative. The main agency who carry out the monetary policy is mainly the Federal Open Market Committee. So whatever we see in the newspaper, that means when the Fed fund rate determination, when we see that Fed change the interest rate, actually we are referring to the meeting of the decision of the Federal Open Market Committee. Their announcement is actually shortly say that Fed announce changes in rate of interest or Fed fund rate, like that. So shortly this is the Federal Open Market Committee, that is FOMC is the main committee that is interested to do the monetary policy. So you can also see that open market operation is one tool we know that as part of monetary policy. So this FOMC, that you can see that they directs the open market operations, and the Board of Governors, you can see that this is one of the tool. Open market operation is one of the tool, and second another tool, you know, that discount rate, and the third one is reserve requirement. So here you can see that the 12 Federal Bank Reserve Bank, they establish the discount rate same, then the Board of Governor reviews and determines the discount rates, right. Then you can also the reserve requirement, this is actually sets within the limits by Board of Governors, and the FOMC advises for the setting up of the reserve requirements. So here the important thing is that the main tool, the most widely used tool or more powerful tool in the determination of interest rate in the US is mainly the Federal Open Market Committee, that is mainly directly set up by the FOMC. So what you can see here is that overall the structure of Federal Reserve banks, as I said that there are 12 FRBs. These are each of these FRB, they are quasi public institution owned by private commercial banks in the district that are members of the Fed system. So the board of the members, here there are class A directors to represent the professional bankers, and in addition to that there is class B directors nominated and elected by member banks in each Federal Reserve district to represent the general public, that means prominent leaders from industry, labor, agriculture or consumer sector. And in addition to that there are class C directors also appointed, that is appointed by the Board of Governors to represent the general public. So my objective here is to put all these aspects, details, is to highlight the fact that the US Federal Reserve System is highly decentralized and is consist of general public, not only the banking system, it also include banking system, general public, that is the coming from different sectors of the country's economy and society. As compared to this one, we can see that India's reserve banking system doesn't have this kind of structure. India's that RBI, you know, that it is set up by is a quasi constitutional authority set up by the constitution, and you also know that we don't have this kind of decentralized structure in the Reserve Bank of India. So the member banks, all national banks are required to be members of the Federal Reserve System, and commercial banks chartered by states are not required but may choose to be members. And Depository Institution Deregulation and Monetary Control Act of 1980 subjected all banks to the same reserve requirements as member banks and gave all banks access to Federal Reserve facilities. So the duties of the Board of Governors, especially with regard to the monetary policy, we can see that this is votes on conduct of open market operation and sets reserve requirement, that the required reserve ratio sets that what is the required reserve ratio, then control the discount rate through review and determination process. And let us also before going further, moving to discussion of the monetary policy, let us see what are the specific functions of the Federal Reserve Banks. So, one is to conduct nation's monetary policy to promote a maximum employment, stable prices and moderate long term interest rates in the US economy. Though we say that is US economy, we can say that the Federal Reserve System is the most powerful central bank in the world, and their rate of interest, for example, when they determine influence the Fed fund rate, that is the interbank rate, that actually influence. The influence is not only limited to the US but across the globe, right? That also you are familiar with that whenever Fed Reserve System, when they announce Fed fund rate change, the tremors are seen, felt across the globe, and even the stock markets of many countries are also get affected. Second one, to promotes the stability of financial system and seeks to minimize and contain systemic risk through active monitoring and engagement in the US and abroad. And third one, promotes the safety and soundness of individual financial institutions and monitors their impact on the financial system as a whole. Fourth one, foster payments and settlement system safety and efficiency through services to the banking industry and the US government that facilitate US dollar transactions and payments. And finally, promotes consumer protection and community development through consumer focused supervision and examination and research and analysis of emerging consumer issues and trends, community economic development activities and the administration of consumer laws and regulation. Let us now see how Federal Reserve Banks formulate the monetary policy. The directives, they establish the discount rate, the rate at which commercial banks can take loans from the central bank, reserve banks. It decides which banks can obtain discount loans, and the directives select one commercial banker from each district to serve on the Federal Advisory Council, which consults with the Board of Governors and provides information to help conduct monetary policy. So, 5 of the 12 bank presidents have a vote in the Federal Open Market Committee on a rotational basis. So, about the Federal Open Market Committee they meet 8 times a year, and you know that the implication globally, as I just stated a couple of minutes before, that means every time when the Fed announce the decision of the Federal Open Market Committee, that FOMC, that means mainly their decision is with regard to the Fed fund rate. Fed fund rate, that we call it Fed rate for short. That is the rate of interest between interbank loans that banks borrow between each other to meet their reserve requirements. So, you know that when Fed fund rate is increased, when the FOMC increase the Fed fund rate, then you know that the rate of interest increase. Obviously, when the Fed fund rate increase, you also need to see that other rate of interest also increase. So, as a result, there is actually capital inflow to the US, which also affect other countries. So, consists of 7 members of the Board of Governors, President of the Reserve Bank of New York and Presidents of 4 other Federal Reserve Banks. And the Chairman of the Board of Governors is also the Chair of FOMC. So, issues directives to the trading desk at the Federal Reserve Bank of New York. And before going further, before we proceed with the Fed fund rate determination, before discussing this mechanism, let us see what is the Fed's ability to control the monetary base in the economy. So, we see that there are several tools. One tool is open market operation, and we have seen that open market operation, we also call it as non-borrowed reserves. And how do they do it? Actually, the open market operations has been carried out daily through the trading desk. Sale is completely controlled by the open market sale or purchase, even both completely controlled by the Fed by placing orders through dealers. in the open market operation, it is done through that. So because of that, what we can see that they have more control. Suppose the central bank, the Fed decide that they need to inject this much money supply, for example $1 billion they want to inject. So here actually if they desire, they want to inject this much in the economy, and accordingly they can carry out an open market operation. So they can give the order to the place order through the dealers. That means they are going to sell buy this much worth of government securities from the banking system. Another tool is discount loans. Discount loans is actually we can call it as the borrowed reserve at bank rates. That means this is the rate at which the commercial banks they can borrow from the central bank without any collateral. So at in India, for example, there is we have the repo rate with the collateral. This is about Indian context, but in the US actually mainly they use the term called discount loans. And what we can see here is that Federal Reserve sets the discount rate, and then banks make the decision about whether to borrow or not. That means using this tool, the amount of fund, the amount of money that is injected into the economy, not only decided by the central bank but also by the willingness of the banking system to borrow, right. So in this way, what we can see here is that totally when central bank, Federal Reserve System, when they want to inject money, they have two options. One is through open market operation. Then what we saw in the previous discussion, that when they do that, the reserve is going to increase, right. So when they do that, central bank, we say that actually this is monetary base. What we have seen that C plus R, right. That what we have already written it here. That means MB is equal to C plus R. When open market operation is carried out, we can see that this reserve is going to increase. Reserve is going to increase when they carry out open market operation. So when they do inject money, actually the first sign is that the reserve of the banking system increase. So that means the reserve through open market operation, we call it non-borrowed reserve when they do open market operation. So when they purchase government securities, then the non-borrowed reserve increase, and in contrast, if they sell government securities to the banking system, then the non-borrowed reserve decreases. And coming to the second part, the discount loans, this we are going to say that again the objective is same, that is they want to change the money supply in the country, maybe increase or decrease. So when they increase the rate, when the discount rate is increased, then you know that the borrowing from the central bank by the commercial bank decrease, then the reserve decreases, right. Otherwise if they reduce the discount rate, and we can see that the banks will be borrowing more from the central bank, and this injecting of money through this, and the immediate effect is that the reserve of the banking system increases, and we are going to call it as borrowed reserves. So in that way we can reclassify monetary base, we can define it as NBR plus BR, and we can also define MB as currency plus reserve. So these are the two way of defining the monetary base here. To here mainly we can see that the ability, Fed's ability to control the monetary basis mainly through open market operation, to some extent by discount loans. So we can say that if you want to rank it, the first we are going to say that open market operation is by using open market operation, the Fed has more control in influencing the money supply, because whereas the amount of open market purchase or sale is completely controlled by the Feds placing orders with the dealers in the bond market, and the central bank cannot unilaterally determine and therefore cannot perfectly predict the amount of borrowing by the commercial bank using the second window. So that means they have more control over OMO. Accordingly they can clearly determine the monetary base, but using discount loans they don't have that perfect control, but they can influence. In addition to that, we have also seen that other that floats and treasury account that we have discussed in the previous session, that also has influence on the monetary base, but these two things are not on the hands of the Fed. However, these are very short term aspects, so Fed will be having a clear idea how much will be the float and how much will be the treasury deposit. So let me stop here. In the next session, we will continue this discussion and see how Fed fund rate is determined by the Fed Reserve System. Thank you.